In this week's update, is this the start of a new gold run? Tech is back and other aggressive sectors are running hard. And we'll have a quick peek at the Bitcoin chart. My name is Garry Davis, and as always, this is general advice only in this video, and please remember to like and subscribe to the video. Market perspective this week, it's been a lot calmer than we've seen, and it's turned positive again, certainly for the more aggressive sectors. So the weakness we saw in late February and March, beg pardon, was seasonal, and was really just a bit of profit taking. I think the rise in the bond yields was really just a bit of an excuse for some profit taking that needed to happen, and that's the way that it's played out. And we've got back into a stronger seasonal period for tech stocks and other aggressive sectors, and they've taken off accordingly. So growth is definitely making a comeback. We'll take a look at the spread on that growth versus value ratio that I look at pretty regularly, but also, and probably even more impressively, consumer discretionary is just going absolutely gangbusters, and so are the Dow transports. So they're painting an extremely rosy picture. And when you couple that with the good economic data and the very strong price charts, it's very hard not to be bullish at the moment, that's for sure. So what should we expect in tech in the near term? Normally what we see is a run-up in prices into the earnings results. That's the normal sort of process that you see. I don't see any reason why that won't happen again. It's in anticipation of higher than expected earnings. I'm noticing, looking at a number of individual US stocks, that analysts over the last 13 weeks have been raising their expected earnings and revenue estimates. So that's why the prices tend to move up into earnings. Earnings season kicks off next week. So I think we'll certainly see some probably pretty positive moves. But I think the big thing, because often you get a positive move leading into the result, the company meets or beats expectations and the price sells off, and you're left scratching your head wondering what the heck just happened. So often there is a buy the rumour, sell the fact kind of response in the market. But if forward guidance is really strong and beyond expectations, then I think that can help overcome that sort of normal situation in the market. So I think the forward guidance that we're going to see in the next month or so is going to be really important. But the way the economy is roaring along, it's very hard to see that, guidance is not going to be very positive. So I think the odds favour it being a pretty bullish period. And of course, there'll be none better in the technology sector than semiconductors. Semiconductors, there's a worldwide shortage. It doesn't appear as though that situation is going to change at any stage in the next couple of years, because the investments required to ramp up production of semiconductors, you're talking tens and in some cases hundreds of billions of dollars of investment. Taiwan Semiconductors is planning $100 billion worth of investment in new plant and equipment over the next few years. So these things just don't happen overnight and without absolutely massive investments. So I think we're in for a pretty good period in semiconductors, and they certainly are trending very, very strongly. Okay, before I get into American stocks, let's just look at a couple of different charts. So we'll start first of all just with a quick peek at the Bitcoin chart. Not that I'm an active Bitcoin trader, because I'm just not. But this is the chart. You can see clearly all the moving averages are still rising. They're still stacked up in the right order. The 20 above the 50, above the 200. So the trend remains. But you can see that it is in a period of consolidation. We had a little breakout, so it's not a classic ascending triangle. It's a bit messy, but there's no question that we've got a zone of consolidation, and that zone of consolidation, based purely on technical grounds, should break to the upside. Now that doesn't guarantee it, because you can always get ascending triangles that do break down. But if if you're looking at the odds, then that's where the odds are that the next move, when this consolidation is finished, is to the upside. Now the other key ratios are this is the consumer discretionary against consumer staples. So you can see since the March crash, consumer discretionary has absolutely killed the staples sector. We had a little bit of a change around over the last month or so, where money went a bit preferentially towards the staples, but consumer discretionary is back, and back very strongly if you look at a lot of individual charts. So that's looking very good, and this is the growth versus the value lines. So IWF against IWD, and you can see that IWF, the growth sector, has been outperforming value for a long period of time, really since the start of 2017. So we're talking in excess of 3 years. Now that all changed to a degree in November, when the first vaccine was announced, and certainly money rotated from some of the aggressive sectors and rotated back into some of the sectors that had been hit very hard by the COVID lockdowns. We got some stability above this key level here, which is about 1.67, but then it broke down again in March, again in line with that seasonality. And we went down, no coincidence, we went down and found support, pretty much exactly where you'd expect to find support, where previous highs and lows were. And we've bounced very nicely off that support, and particularly in the last week. Now, the important thing will be for the health of the growth sector is for this line to get back up above 1.67. So we want to see this ratio back above 1.7 in the not too distant future. But look, it's all setting up extremely positively. All the technicals are in line with the seasonals. It's in line with the fundamentals. You don't get things lining up a whole lot better than they are at the moment. Okay, let's just look at the SPY while we're here. The S&P, that's the monthly chart going back to the mid 60s. So you can see we're clearly in a big picture secular bull market, which started in 2013. If the average has been anything, this will probably run for at least to 2030, with a couple of interruptions along the way that might look like what we saw in March of 2020. It might look like what we saw in 2002, 2003, or it might look like the GFC. There's no way of knowing in advance, but we'll probably get one or two more of those in the next 5 to 10 years. But that will not change the fact that we are in a secular bull market, and in that situation, strong stocks tend to outperform. So this is the S&P. You can see it had a great week, really accelerated into Friday, closed virtually on its highs. It's about as far above the moving averages as it ever gets. So you see here back in the 2nd of September last year, when it got this far above the moving average, we did get a sharpish pullback. However, this time we're entering a seasonally strong period of the year leading into earnings. So this may continue on for a little bit longer yet. But the orientation of everything on this chart is extremely positive, as you can see, and it's pretty hard to call anything other than a continuation of this bull market. Now, if we look at the Nasdaq obviously was affected during late February and March, but it is really strengthened again now. We haven't broken out just yet, but we're probably not far from it. So that's the Nasdaq. And if we look at the currencies, this is the US dollar. So we're now back into an uptrend. We've got higher highs and higher lows. We did retrace last week, but we are still forming higher highs and higher lows. So until that changes, until and unless we break this level here of about 91.5, then the US dollar is in uptrend, and that has, of course, consequences for commodity prices. The Australian dollar, not quite as weak as the US dollar has been strong, so our dollar has held up a little bit better than what I would have thought, and I guess that's because we're seeing buoyancy in currency markets. So let's just check on the slide for American stocks. So the S&P put on just under 3% across the week, which is a very robust gain. And the Nasdaq, however, beat it with a nearly 5% rise. Now, a lot of that on Friday was due to strength in Amazon, Apple, Google, and Microsoft in particular. And that's normal for how we come out of periods of selling. The big stocks are the ones that get bought first, and then it filters down the line to mid-cap and smaller stocks as things progress. So this is playing out pretty much as you would expect. US dollar 91.18, the key level as far as the trend goes is 91.5. Now the 10-year yield backed off a little bit to 1.66, which certainly didn't hurt the chances of the technology sector. The VIX fell below 17. So that's a very positive part of what happened in America. In our market, our dollar was essentially flat across the week, just under 76. And our index rose by 2.4%. And you would think we'll probably put on a bit more on Monday. Now, the strength in the Australian market, there's no question the place to be if you want to make good gains, albeit with some volatility. But the gains are in the smaller cap stocks. There's no question about that in a number of different areas, whether it be mining, digital finance, pharmaceuticals and biotechnology, or some innovative industrial areas. That's where the progress is being made. But you need to understand what happens with the price cycle of early stage stocks, be it mining stocks or something else in another industrial area. There is a reality to how the price cycle often works, and you need to plan and understand that. And what I mean by that is best shown by this chart here. And it shows the typical cycle that happens for an early stage stock, where you get an initial burst of euphoria that takes the price up to, with hindsight, just a crazy level. And it's really just momentum, it's social media, it's greed, it's all those things, inexperienced traders all feeding in, and people just, keep buying and buying and buying until the music stops, and then, a couple of people are left without a chair to sit on, and the price comes back very, very savagely. So a lot of these small cap stocks that have got enormous futures, but where commercialization is not likely to occur for, let's say, another 2 to 3 to 4 years, they will often go through this sort of price cycle. So unless your game plan is structured to accommodate that, and you have a good idea of what's coming or what's potentially coming, then you can get caught out very badly. So please remember the price cycle for small caps. But if you want to make really outsized returns, then this is the area that you need to be, and it can be done. You can navigate these areas very, very well, but you need to be really clear about what your game plan is. Turning now to precious metals, and there's some very good signs all of a sudden in the precious metals market. Now, we saw this back in the end of 2020, and the rally wasn't sustained. So this is not a guarantee of anything. All we have in the market is balance of probabilities and weight of evidence. But at the moment, things are lining up pretty well for gold stocks, and I'll explain why. So gold ended up rising $13 to finish at $17.44, which is the best level we've been at for a while. And silver also recovered as well to just over 25. Now, in hindsight, it's really easy to see the capitulation selling that occurred in late February. One of the drivers of that is the fact that the futures market, whilst the buying and selling in the futures market doesn't sustain long-term trends, it does influence the short-term because there is just so much leverage being used. It's typically 20-to-1 leverage that the futures traders are using. And so they can't accommodate any sort of significant move at all. They've got to sell out. And so we saw that process playing out and really reached its peak in late February, and we'll see that on the chart. So that is often where the bottom is, and I think that's going to prove to be the case this time. If we look at precious metal stocks, they've formed a very encouraging base. They are starting to outperform quite sharply in the last few days, so that's always a good sign. The sentiment has been dreadful, so that's a positive indicator. When sentiment is really, really bad for precious metals, you're generally pretty close to the bottom and pretty close to a turn up. And as we've seen, turns higher in the precious metals sector do tend to be fairly sharp. And on top of that, the situation is supported by pretty strong earnings fundamentals as well in gold stocks around the world. So let's look at some charts to show you what I'm talking about. Just before that, I'll just there's the ASX 200. So we finished just a tick under 5 points under the 7,000 mark. So we're at not quite at new all-time highs. That occurred before the crash in February of last year, but we're certainly working our way up towards that. But looking at precious metals, there's the silver chart. So we dipped under the 200-day, which is what I reported on last week, which was a bit of a concern, but it's very quickly turned around and picked back up again. But I'd have to say there's no really outsized candles here, so it's still a bit tentative in silver. If we look at gold on a daily basis, so you can see now that the 20-day, the green line, is just now turning up. The price has got above it again, and we really need the 20-day to cross over the 50 and the price to be sustained above that. So we're at a pretty critical level here at about just under 1770. So we need gold to keep moving and get above and close above 1770. So that's a pretty important line in the sand. If you look at it on a weekly, you can see it's been quite a sell-off since the peak in August last year, and we did get this bit of a crescendo in selling, which we'll see in GDX. So I'll just show you GDX. So you can see it's a bit hard to see on this chart because there was such a concentration of selling over here in March of last year, but you can see definitely on these final couple of days, I'll just zero in here. Yeah, that makes it a little clearer. So it's these 2 or 3 days here that I'm talking about was really the capitulation at the end of February. You can see how much the volumes went up. They were nearly double what they'd previously been. So that was probably the low point. Now the key here is we've now got higher highs, so higher highs, and we've got a higher low. So by definition, we are now into an uptrend. Now the key is, will that uptrend be sustained? We don't know yet, but one thing that's positive is that gold turned down on Friday night, but GDX managed to close on its highs and basically was flat on the session. So that's important. And you can see we've just got the beginnings of maybe on a relative comparison basis, GDX starting to outperform the S&P. And that, of course, will bring fund managers in who can't afford not to be riding the best horse in the race. So quite a few things are lining up for the gold sector. Now, if we look at some of the spreads, this is the GDX divided by GLD. So that's the performance of the gold miners versus the gold price itself, or the gold ETF. That's big picture. So you can see we've got quite a big base here. that started forming back in 2016. But we are moving, we've had a sell-off from a double top, but now we're starting to move back up again. And I'll just zero in on that to make it clearer. So you can see definitely, so we've now got higher highs and higher lows, not only in GDX itself, but relative to the gold price. We're also moving back up again. And that's the gold to silver ratio. So that's the situation in the gold market. So let's unpack that just a little bit more in terms of the outlook. What is normal for GDX? What does GDX normally do when it goes into a new up leg? These are averages. It's a simple average over the last 4 up legs, so this is hardly statistically rigorous. But the average, for what it's worth, is roughly 100% average gain over a period of 7 months on average for GDX. So that is what is normal. Now that's not a guarantee or a prediction or anything else. That is just what has happened over the last 4 up legs. But given the way that things are lining up for the sector, I don't see any reason why that average can't be replicated again. So what's the probability around that? What are the factors that make that more probable than not? The first one is that gold miner earnings are surging around the world because the gold price, despite the fact that it's been a bit weak in the last month or two, the gold price, the average gold price achieved for gold miners is higher than previous years. They've been able to contain their costs, and so their net margin has actually been rising quite steeply. So earnings are surging, balance sheets are in far better shape than they were 4 or 5 years ago. So from a fundamental point of view, things are looking good. They're generating very significant free cash flows. You look at the Australian miners, Newcrest and Northern Star and Saracen before the merger. Those sort of stocks have got just spinning out massive amounts of free cash flow. So the fundamentals are very good. However, the fundamentals don't hold the stocks up when sentiment turns against. And the price of Northern Star has come off from around $14, $15, came back to just over $9. So good fundamentals don't stop the share price getting smacked. Sentiment became dreadful, and that is a positive. It's hard if you're caught up in the middle of it, but at some point sentiment just gets so bad that all the selling is done, and the only way for the share price to go is back up again. And I think that's what we're starting to see the beginning of now. So the technicals look very promising on gold stocks, and adding to the fundamental picture, valuations are historically cheap. If you want to look at ratios of PE, ratios of free cash flows, whatever metric you want to look at, valuations are pretty cheap, both compared to history for the sector, but also compared to other stocks in the general market as well. So probability is in favour of a productive period. What are the risks? There's always risks that it doesn't pan out, and we saw that there was a failure for a new uptrend to really get started and sustained late last year. So the risks are that real interest rates turn positive. Now again, this is a bit of a misunderstanding. There's a bit of a myth, a bit like the yield and tech stocks. The conventional thinking is that if the yield goes up, tech stocks sell off. The numbers don't actually support that. That's a belief, but it's a belief that's actually false, not based on statistics. There is also another belief that when real interest rates, so that's the nominal rate less inflation, when real interest rates turn positive, that's actually bad for gold, because gold doesn't pay a dividend or any sort of yield, and so therefore real interest rates are bad for gold. But again, the statistics, pardon me, don't actually support that. Yes, there are short periods when interest rates or real interest rates turn positive and gold is affected. But if you look at all of the numbers, gold can still perform when interest rates are real and rising, real positive. But look, at the moment it's purely academic because real interest rates are negative. If you take the nominal rate, less inflation, less proper inflation, not the manipulated, manufactured numbers that governments are trotting out around the world, but the real inflation means that real interest rates are still negative, and that's a positive environment for gold. Another risk is that inflation remains contained. Now, at the moment, there's a huge debate raging about, are we getting inflation? Will we get more inflation in the future? And no one really knows. Because gold does do better when there is inflation. So that's a bit of a question mark and a bit of a risk. And the other one that could prevent the gold price going up is an absence of fear. Fear is great for gold. Now, this is an environment where you would think there'd always be a level of fear because there's just so many things that could go wrong very quickly. But they're the risks as they stand to a decent rally in gold. So again, I've covered that around the probabilities. So that's we've covered that. All right, now other commodities. Copper was up a bit with the US dollar coming off, and so was nickel. Copper back just above $4.06. And really, it's just the currency effect. Crude oil dropped a bit further. We were up a couple of weeks ago. We were up in the mid to high 60s. We're now down just under $60. And I've said all I need to say about the oil sector. It's just one that's, to me, it's subject to unpredictable geopolitical forces that can change on a dime, change on a government decision and announcement. So it's a sector of the market that I just really can't get extraordinarily interested in because I can't assign much in the way of probability to it. There's the spot copper chart and the nickel chart, both showing better signs in the last week or two. So to wrap things up, the probabilities in the general market are in our favour. The next 6 to 8 weeks are seasonally stronger. We've got multiple tailwinds. The US economy is going great. I showed you the consumer discretionary and Dow Transports sector. In fact, I don't think I showed you the Dow Transports. So let's have a quick look at that. There's the Dow Transports. You don't get a much stronger chart than that. And particularly of late, it was completely immune to the selling in March. And, it's just going along fantastically well. So that's really indicative of how well the US economy is going. Portfolio analyst last week, I covered, there was a bit of fewer questions last week because of, I guess, a lot of people were away for Easter, but I covered numerous terrific stock opportunities both in Australia and America. Went through, probably 20 or 30 different charts. So I think members found that very useful. So that's it for this update on the market. There's my website details and an email address for anyone that wants to contact me. So I'm looking forward to probably a pretty buoyant week next week, and I'll be back with you on Sunday. Cheers.